From Carr, Riggs, and Ingram, this is It Figures, the CRI podcast, an accounting, advisory, and industry-focused podcast for business and organization leaders, entrepreneurs, and anyone who is looking to go beyond the status quo.
Hello, I'm Scott Bailey, partner with Carr, Riggs, and Ingram in our Raleigh, North Carolina office. I specialize in insurance with a focus in captive insurance, along with manufacturing and construction. I'm here today to talk with Stephen Larady. Stephen, if you want to tell us a little bit about yourself.
Sure. I'm a partner in our Nashville business unit. I also specialize in insurance with a focus in alternative risk management, mainly being captive insurance companies and risk retention groups. And I also work with distribution clients and employee benefit plans.
Fantastic. And what we want to talk about today is to go through an overview or the basics of risk retention groups, or RRGs. So just starting off with the basics there, what is a risk retention group?
So a risk retention group is a type of captive insurance company where it's really a group of different companies or insurers coming together as a group to really purchase insurance and also self-insure insurance within a group. And there's several different ways that they can do that, but at the highest level, it's really just a band of different insurers coming together to either self-insure or purchase some kind of group insurance through the reinsurance market.
So do these need to be similar types of companies or similar risk? Just, what is it that makes these groups come together to express an interest in forming a risk retention group?
So yes, by definition, under the Federal Risk Retention Liability Act, it does have to be similar insureds with a similar type of risk that they are covering. So usually what you see is say a group of taxi cab companies or a group of doctor's office that have a similar liability risk that they need coverage for, being auto liability, medical malpractice. Those are the two most common. And there's others that it can be as well, but those are really the two that you see the most in risk retention groups.
Gotcha. So in forming an RRG, a risk retention group, we're talking about the formation of an insurance company for all intents and purposes, right? So in doing so, there's got to be some regulatory considerations. So I'm assuming these are registered, licensed by departments of insurance. Could you expand on that a little bit?
Yes, they are. And so there's different, let me start with risk retention groups have to be a domestic insurance company, that being has to be located and domiciled within the United States. From that, you have your pick of different domiciles that they can pick, whether it be Vermont, Tennessee, South Carolina, and there's a few other, North Carolina, a few other dominant domiciles as well. So they do have to go through the licensing with the State Department of Insurance of the domicile that they choose, and they are ultimately regulated by that domicile. Now, what makes risk retention groups unique is that most insurance companies or most captives, once you're licensed by a domicile, you can only underwrite risk within that domicile, whereby the Risk Retention Act allows them to essentially write that liability coverage within any of the domestic U.S. domiciles.
Gotcha. So not only do you have to think about your filings in the state of domicile for the risk retention group, you've also got to think about activities and filings in all these other locations where they're writing coverages. Is that
you do, and that's a big thing on the reporting side that's different between risk retention groups and other captives. Most captives, you only have to file your annual report with the state that you're domiciled in, and it's typically going to be on a prescribed form by that state. Whereas risk retention groups have to file the same type of NAIC filings that a commercial carrier or a mutual insurance company would. And so the way that typically works, you're going to, again, fill out that general NAIC annual statement, quarterly statements, and then that will get sent to both the NAIC and then every state that insurance company is writing coverage in.
So that probably has some tax implications too, wouldn't it?
It does, mostly from a standpoint of your premium taxes. And so with insurance companies, they would be liable to pay premium taxes to each state for all the direct coverage that they write within those states. But where that really gets hairy is that most states also have retaliatory tax clauses.
Well, that sounds kind of bad, but
it does. But essentially, at a very high level, all that is that say if I'm Tennessee and Scott is North Carolina, and I'm making these numbers up, but say Tennessee's tax rate is 2%, and if I'm a Tennessee company writing in North Carolina, they're going to charge me 4%. And by Tennessee law, if it's a North Carolina company writing coverage in Tennessee, we would typically only charge at 2%, which is our rate. But we're going to say, well, if North Carolina is going to charge us 4% if we do business in their state, we're going to make them pay 4% if they do business in our state too. And so really, the simplest form where you get to in a lot of cases is going to be the highest rate of your domicile and the state you're writing in is going to be the tax rate that you ultimately have to pay.
Gotcha. What are some of the other regulatory filings that a risk retention group has to file in addition to what a traditional carrier insurer might have to write?
From a traditional carrier standpoint, I think a lot of the filings are going to be similar, or maybe file a little bit differently. But where you get the differences at is really when you're comparing a risk retention group to the other alternative risk forms, whether that be just a pure captive or a protected cell series captive. They do not have to file that NAIC document, and that's really where the crux of a lot of their reporting falls into. There's just a lot more detail that goes into that. There's also certain risk-based capital reporting that they have to do to the state of domicile, and that's basically just a way to see what the minimum capital requirements are for that risk retention group based on its size and the coverages that it is writing. There's some others as well, like they're required in every domicile to do an annual audited financial statements, whereas other captives, it's domicile by domicile, but a lot of them it could be optional depending on where they are domiciled at. They also are required to file the actuarial opinion, whereas a lot of the other captive types don't necessarily have to file that.
Right. So it sounds like in those regulatory filings, it's very similar, just with a little additional detail. So given that, when it comes to their audited financial statements, because I heard you mention that just a moment ago, do these follow the traditional statutory regulatory system, the model audit methods of financial reporting? Do these follow generally accepted accounting principles or GAAP? How do these follow?
So it can be really either of the two, depending on the domicile it is located in and what the requirements are within those domiciles. But the vast majority of domiciles under their captive insurance laws will either allow or require risk retention groups to file their financial statements using generally accepted accounting principles, which is different than from a normal commercial carrier or a mutual insurance company, where they would be required to file under the statutory accounting basis. Now, the catch to that is even though the financial statements are filed on a GAAP basis, they are required to have a reconciliation for their capital and surplus and their net income from the GAAP basis to the SAT basis.
Gotcha. Good stuff to note. Switching gears just a little bit. What are some of the unique characteristics that interested companies might have to have in order to come together? Are there any specific ownership requirements to form one of these? Are there any regulations over who can or how to put a risk retention group together?
So really, with the thought of a risk retention group being a band of insureds coming together to self-insure or to purchase insurance as a group, the main requirement that is out there is that every member or stockholder of a risk retention group is required to be insured by that group, and then vice versa. Anybody who is insured by the risk retention group must be an owner of that risk retention group. So it is purely the owners insuring themselves.
Great. So these really sound like an excellent alternative for like companies with like coverages to really start finding ways to leverage their risk management programs to find value through the use of a risk retention group, through this risk sharing program. They sound like a really great option. What other thoughts do you have on these?
Well, as far as where they are a good option and not, where we see them being the most successful and really makes them a great tool is that you can be selective as to who you allow into your group. And then once they're in that group, the risk retention group can put different cost control measures in place, whether that is, just looking at it from an auto liability standpoint with say a trucking company, they can do different safety awareness classes or driver awareness classes at the insured level, and you can really put some certain criteria. So companies that have large loss ratios or unfavorable loss history don't necessarily make it into the group, and so it really shines for those who have a good history of controlling their losses and have a good loss ratio to take that profitability out of the hands of the carriers and putting it within the group so that those members can share in their underwriting profits.
Excellent. Well, I hope we can find a way to help some of our current clients and reach out to future clients to find a way to offer these benefits to companies who are doing really well in their risk management efforts. And any closing thoughts?
Just, one thing I think that is important to know with the risk retention groups as well from a coverage standpoint, I don't know that we hit on this earlier, is that the coverage must be written domestically. So you cannot have, say a risk retention group insure liability insurance in the UK or any other, non-US domicile. It also must be commercial liability insurance, so you can't try to do this for property coverage, workers' comp, or personal insurance. So it is, you do have a targeted group that really the risk retention groups are going after, that being the liability carriers. But, I think anywhere that you see a hardening insurance market, like right now, the auto liability is a huge one where companies are getting hammered. Would be a good prospect for it.
Excellent. Well, Stephen, thanks for your time today. And thank you to the listeners for hearing our podcast on risk retention groups. Thanks.
Thank you.
If you want more CRI insights or are interested in learning about our firm, please visit our website at cricpa.com. Thanks for listening to this episode of It Figures, the CRI podcast. You can subscribe to It Figures on iTunes, Spotify, or wherever you prefer to listen to your podcasts. If you liked what you heard today, please leave us a review.